Hey everyone, welcome back to Corporate Decoder, the place where we dig into corporate filing so you don't have to. Get ready to hear about a company that's had more extensions than a bad hair day. Today we are talking about Relativity Accession Corp's annual report, and it's a story of a blank check company racing against the clock. This is a special purpose acquisition company, also known as a SPAC. Basically, it's a shell company that raises money through an IPO with the goal of merging with a real operating business. So far, there are not much securities registered, as you can see in the header, other than the float with a value of around $1.8 million. A big part of Relativity's story involves trying to find that merger partner. They were previously in a deal to combine with SVEs, which sounds like a company that deals with connecting full-price fashion brands with off-price retailers. However, this deal was later terminated, a mutual breakup on Valentine's Day it seems. Now they are focused on a new deal. A business combination agreement with Instinct Brothers Kosi, a Japanese corporation, for around $200 million that should be a new target company. One key element to understanding this company's journey is all of these extensions. Relativity has pushed back its deadline multiple times. They're currently operating under their fourth extension, giving them until February of next year to complete a deal, and to extend, they have taken a number of unsecured promissory notes. Let's look at some numbers. The financials are not great. As of 2024, Relativity reported a net loss of around $440,000. Most of that loss comes from general and administrative costs, basically the expenses of running the shell company. The good news is that the trend is improving compared to the previous year. The net loss as of December 2023 was at $2 million, almost 5 times the 2024 number. The major difference is the general administrative cost, since they did a lot of hunting for an acquirable target. The operating activities paint a similar picture. There was a huge boost to cash in 2024 of around $1 million compared to a loss of similar numbers in 2023. All this raises some big questions. The annual report itself says there is substantial doubt about the ability to continue as a going concern. In plain English, there's a real risk this company might not survive. It's not just about finding a business to merge with, they need to do it quickly and under favorable terms. Leadership is another area to watch. There have been some recent changes in their board of directors. A director recently resigned. That can sometimes signal internal disagreements or shifts in strategy. They are trying to play it safe. They instructed the trust to liquidate some investments and hold it as cash. This was done to mitigate being called an investment company act. Digging into the details, their accounting practices around warrants, which are essentially options to buy stock, are important. These warrants are treated as liabilities and their value fluctuates with the market, which impacts their financial results. So a company that's basically just trying to get to the finish line to complete the merger in time. Also, the company says internal controls are not effective due to the failure to timely close the books for every fiscal period. All things considered, this does not look good. Also, they highlighted, as any company would, the potential risks. The big ones mentioned includes inflation and higher interest rates, and the conflicts in Ukraine and the Middle East. It's a reminder that the world events can impact even a company that is primarily just trying to find another business to acquire. The incentives at play are also worth noting. The founders stand to gain significantly even if the stock price isn't great, which creates a potential conflict of interest. It's a classic SPAC problem. But what's mostly happening are the expenses. You are paying $10K a month for just existing, and with that level of trust account, it's mostly a ticking time bomb for the investors. So what's the verdict? The clock is ticking. To be clear, I am not a fan of SPACs, and I particularly dislike this one. The company has to complete the deal by February next year, or it might end up in liquidation. Thanks for watching. If you found this corporate decoder breakdown helpful, be sure to like, comment, and subscribe for more deep dives into the world of finance.